This is the only investing book Warren Buffett has consistently recommended throughout his entire career. Not because it predicts the market, not because it promises fast returns, but because it teaches something far more important: how to think correctly about investing. In a world of hype, speculation, and financial noise, especially in the volatile markets of 2026, The Intelligent Investor by Benjamin Graham remains the definitive guide to protecting capital and building long-term wealth. This book is not exciting, it is not trendy, and that is precisely why it works. Why? This book still matters in 2026. Markets today move faster than ever. Algorithmic trading, social media-driven speculation, short-term performance obsession. Yet human behavior has not changed. Fear still dominates crashes. Greed still dominates bubbles. Benjamin Graham understood this decades ago and built a framework that works regardless of market conditions. At the core of that framework is a crucial distinction: the two types of investors. Graham divides all investors into two categories: the defensive investor, the enterprising investor. This distinction is not about intelligence. It is about time, temperament, and discipline. The defensive investor, applied to 2026. The defensive investor seeks safety of principal adequate, consistent returns, minimal effort and decision making. This investor does not try to outsmart the market. Instead, they focus on broad diversification, high quality securities, long-term holding periods. In 2026 terms, a defensive investor may favor low-cost index funds, high-quality dividend-paying stocks, bonds, or bond funds for stability. The defensive investor's goal is not maximum return. It is avoiding serious mistakes. As Graham emphasized, the essence of investment management is the management of risks, not the management of returns. The enterprising investor, applied to 2026. The enterprising investor is different. They are willing to spend time analyzing companies, study financial statements, act decisively when opportunities arise. But Graham sets a strict condition: enterprising investing requires extra effort and superior discipline. In 2026, this may include valuation-driven stock selection, buying undervalued companies during market pessimism, avoiding speculative trends and momentum trading. The enterprising investor is not aggressive. They are analytical. The key difference is not risk tolerance. It is work ethic and emotional control. Why most people choose the wrong category. Graham warned that many investors fail because they overestimate their abilities. They behave like enterprising investors. Without doing the work, this leads to overtrading, chasing market trends, buying high and selling low. The intelligent investor chooses a category honestly and stays within its discipline. Mr. Market, Graham's most powerful idea. To explain market behavior, Graham introduced one of the most important analogies in investing history: Mr. Market. Imagine you own a business with a partner named Mr. Market. Every day, Mr. Market offers to buy your share or sell you his share. The price he offers depends entirely on his mood. Some days, Mr. Market is optimistic and euphoric. Other days, he is depressed and fearful. His prices change constantly, but the value of the business does not. How to use Mr. Market correctly. The mistake most investors make is listening to Mr. Market emotionally. They buy when prices are high because optimism is contagious, sell when prices are low because fear feels urgent. Graham teaches the opposite approach. You are not obligated to trade with Mr. Market. You may ignore him completely. His role is not to guide you. His role is to serve you. The investor's chief problem, and even his worst enemy, is likely to be himself. In 2026 markets, this lesson is critical. Volatility is not risk. Emotional reaction to volatility is risk. Market volatility as an opportunity. To the intelligent investor, price declines are not disasters. They are opportunities to buy quality assets at discounts. Mr. Market's pessimism is useful only if you are prepared. That preparation comes from valuation. Lesson 1. The principle of value. Investing. At the heart of Graham's philosophy is one central idea. A stock is not just a ticker symbol. It is a share of a real business. Value investing means buying that business for less than it is worth, with a margin of safety determining a stock's true value. Graham taught investors to focus on intrinsic value, the real economic worth of a business. This involves analyzing earnings, power, balance sheet, strength, cash flow stability, long-term competitive position. Market price is what you pay. Intrinsic value is what you get. The intelligent investor buys only when the gap between the two is favorable. The margin of safety. The margin of safety is Graham's most important principle. It means allowing room for error, protecting against uncertainty, avoiding dependence on perfect forecasts. In simple terms, buy assets at prices low enough that even if you are wrong, you are not ruined. This principle protects investors from overconfidence, market bubbles, unexpected economic shocks. Why this approach endures: value investing is not about predicting the future. It is about discipline, patience, and rational analysis. In a world obsessed with speed and speculation, Graham's approach remains timeless. Because markets change, human behavior does not. But Graham issued a serious warning. When investors confuse speculation with investment, the results are often disastrous. Lesson 2. Margin of safety, the most important concept in investing. Benjamin Graham stated clearly, the margin of safety is the central concept of investment. If you understand only one idea from the intelligent investor, this should be it. The margin of safety means buying securities at prices significantly below their intrinsic value. Why does this matter? Because investing is not an exact science. Even the best analysis includes uncertainty. Economic changes, industry disruption, management mistakes, unforeseen global events. The margin of safety exists to protect you when reality deviates from your expectations. Why? Forecasting is not enough. Many investors rely on predictions, earnings forecasts, price targets, economic outlooks. Graham rejected this approach. Forecasts can be wrong, models can fail, assumptions can break. The margin of safety does not depend on being right. It depends on not being ruined when you are wrong. In practical terms, this means avoiding overpriced securities, being skeptical of optimistic narratives, demanding a discount before investing. In 2026 markets, where valuations can shift rapidly, the margin of safety remains the investor's strongest defense. Margin of safety versus speculation. Speculators buy based on momentum, popularity, expected short-term price movement. Investors buy based on underlying business value, financial strength, long-term earning power. When price replaces value as the primary decision factor, the margin of safety disappears. At that point, investing becomes speculation, even if it is called something else. Lesson 3. The role of diversification. Graham believed diversification was essential, not as a tool to maximize returns, but as a tool to reduce risk. Diversification protects investors from individual company failures, industry-specific downturns, analytical errors. No analysis is perfect. No business is immune. Diversification acknowledges this reality. Avoiding concentration. Risk. One of the most common investor mistakes is overconcentration. This occurs when too much capital is allocated to a single stock, too much exposure exists in one sector. Personal conviction replaces risk management. Graham warned that even strong companies can produce poor investment results when bought at the wrong price or held in excessive concentration. The intelligent investor spreads risk deliberately, not randomly. Diversification for defensive versus enterprising investors. For defensive investors, broad diversification is essential. Index funds or diversified portfolios reduce decision risk. For enterprising investors, concentration may be higher, but only when supported by deep analysis and margin of safety. Even then, Graham advised restraint. Conviction without protection is speculation. The defensive investor's framework. Benjamin Graham provided clear guidance for investors who seek long-term success with minimal effort. He outlined 4 key principles for the defensive investor. Rule 1. Maintain a balanced allocation between stocks and bonds. Graham recommended a mix of common stocks for growth, high-quality bonds for stability. He suggested a range no less than 25%, no more than 75%. In either asset class, this approach reduces volatility, protects capital during downturns, prevents emotional overreaction. In 2026, bonds may offer lower returns than in past decades, but their role as stabilizers remains critical. Rule 2. Favor high-quality securities. Defensive investors should focus on financially strong companies, consistent earnings, conservative balance sheets. Speculative or highly leveraged companies do not belong in a defensive portfolio. The goal is not excitement, it is reliability. Rule 3. Avoid market timing and forecasting. Graham warned against attempting to predict interest rates, market tops and bottoms, short-term economic movements. The defensive investor invests regularly and systematically. Time in the market matters more than timing the market. Rule 4. Keep costs, low transaction costs, fees, and taxes compound negatively. The intelligent investor minimizes turnover, avoids unnecessary complexity, chooses low-cost investment vehicles. Small inefficiencies become significant over decades. The psychological advantage of Graham's approach. Perhaps Graham's greatest contribution is psychological. His framework reduces emotional stress, removes pressure to predict, encourages patience and discipline. By focusing on value, safety, and diversification, the investor avoids becoming dependent on constant decision-making. This discipline is especially valuable in volatile environments. From speculation to intelligence, Graham made a sharp distinction. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Anything else is speculation. This definition forces clarity. It asks one question: where is my margin of safety? If there is no clear answer, the action is not intelligent investing. Conclusion: stop speculating, start investing. The intelligent investor is not about beating the market. It is about avoiding serious losses, thinking independently, acting rationally in irrational markets. In an age of financial noise, Graham's principles offer something rare: clarity. The intelligent investor does not seek excitement. They seek consistency. They do not predict, they prepare, and over time, that discipline becomes their greatest advantage. If this breakdown helped you understand investing at a deeper level, like the video, subscribe for more professional analyses of timeless investment books. Comment below. I invest with a margin of safety, because markets will always test you. But with the right principles, you don't need to fear them.